Are you completely confused by crypto? I'm here to dispel some of the common misconceptions. Cryptocurrency has often been misunderstood as a fleeting trend, a perilous venture far removed from traditional investment vehicles like real estate. However, as we continue to witness the rise of digital currencies, it becomes evident that they hold profound implications for financial landscapes, including real estate. Could these digital assets offer a viable alternative to fiat currency in property markets? In this session today, I'm going to prevent some of the myths and clarify and give you some insight into cryptocurrencies and their practical applications in real estate. So what are cryptocurrencies? Cryptocurrencies are digital or virtual forms of money that use cryptography for securing and making difficult counterfeit. Unlike traditional currencies issued by governments, they operate independent of central authority, relying instead on a network of computers. This peer-to-peer system, known as blockchain, manages and records transactions collectively. Some of the origins and evolutions of cryptography has its origins in ancient times, but cryptocurrencies as we know them today emerged with Bitcoin in 2009, created by an individual or a group of individuals known as Satoshi Nakamoto. Their introduction marked a shift away from centralized banking towards decentralized networks. Bitcoin aimed to democratize and finance, offering a secure, transparent, and efficient method, laying the groundwork for thousands of other cryptocurrencies. Some of the key characteristics of decentralization: unlike the dollar or euro, cryptocurrencies are not regulated by central banks. This decentralization mitigates the risk of government interference or inflation-related manipulation. Transparencies. Transactions are recorded on a public ledger, promoting transparencies and reducing the possibility of fraudulent activity. Some of the security. Transactions are encrypted, providing a high level of security and anonymity, though the degree of anonymity varies across cryptocurrencies. Limited supply. Most cryptocurrencies have a capped supply, such as Bitcoin's 21 million coin limit. These are set to create scarcity and potentially drive value upward. Cryptocurrencies, though, like Bitcoin, is the most recognizable. Cryptocurrencies have other types of significant roles in the market. For example, Ethereum is famous for its smart contracts functionality. Ethereum enables developers to build decentralized applications. Ripple, or XRP, is known for its digital payment protocol. More than its currency, it's designed for cross-border transactions. Litecoin, or LTC, created by Charlie Lee, it's the first to alter Bitcoin's coin, offering faster transaction times and a different hashtag or algorithm. Some of these stable coins are pegged to external references like the USD to stabilize their value. Examples include Tether, USDT, and USD Coin, USDC. Concrete Bill, CBLD, the main purpose of this coin is to support the development and purchase and financing of commercial real estate, 3D printed homes using concrete, and other rent-to-own homeownership models. The benefits of using cryptocurrencies, their inherent qualities, make cryptocurrencies appealing alternatives to traditional currencies. In real estate, for example, in real estate transactions, it lowers transaction costs. The lower fees associated with cryptocurrencies exchanges, typically less than 1%, make it particularly attractive for large-scale transactions. Traditional banking systems, in contrast, can charge significantly more, eroding profits. Speed and efficiency is also a nuance. A payment process such as blockchain can occur within minutes rather than days. The efficiency of transactions on completing is dramatically reduced, a significant boon for real estate transactions that require expediency. So here's some accessibility for cryptocurrency. So it democratizes the access to financial systems, especially in countries with underdeveloped banking infrastructure. So investors who remain wary of traditional financial institutions in these countries can use cryptocurrency. Cryptocurrency in real estate transactions can also revolutionize how transactions are conducted in the real estate industry. By allowing far more flexible payment options, they enable a smoother exchange process and broaden the buyer pool by including investors with cryptocurrency holdings. So here's a case study from someone that used Bitcoin. So in a pioneering deal in Miami, a real estate developer sold multiple condos directly for Bitcoin in 2021, sidestepping traditional financial channels and appealing to international investors familiar with digital currencies. This transaction is a harbinger of the possible uses of cryptocurrency-backed real estate deals. So cryptocurrency regulation, despite their decentralized nature, cryptocurrencies operate within legal frameworks. So regulatory environments are continually evolving to address concerns related to the security, taxes, and volatility. So regulatory body entities like the U.S. Securities and Exchange Commission, for example, SEC, and the Financial Conduct Authority, FCA, in the UK, play crucial roles in shaping policy. They ensure that exchanges and initial coin offerings, ICOs, adhere to legal standards, fortifying investor protection. Compliance and taxation in cryptocurrency is a big one. Cryptocurrencies are taxable events, and jurisdiction laws controlling transactions can impact how investors buy, sell, and hold assets perceived as risk. And so we have to also mitigate these risks. So cryptocurrencies offers many benefits in mitigating risk. So their value can fluctuate widely, creating uncertainties for investors. So regulatory changes impact cryptocurrency markets, further increasing risk. Volatility management, for example, managing cryptocurrencies volatility necessitates hedging strategies, diversified portfolios, and constant market analysis. So investors can utilize stable coins as a less volatile alternative to traditional cryptocurrencies for transactions, and security measures. So investors can implement robust security measures like multi-factor authentication, secure wallets, and reliable exchanges to protect digital assets. Liquidity pools, enhancing the safety and opportunities for crypto investors is the evolving landscape of decentralized finance, DeFi. Liquidity pools have emerged as foundational pillars, enabling seamless trading, lending, and asset management without traditional intermediaries. Unlike centralized exchanges, where order books facilitate buyers, sellers, liquidity pools are smart contracts containing locked by investors, bring liquidity to the market. Pools gain traction, understanding their mechanism, and becomes crucial for prospective investors seeking specifically to capitalize on crypto opportunities in the real estate sector. So the mechanics of liquidity pools, such as collections of the funds, they're locked again in smart contracts, and these are designed to facilitate efficiencies on decentralized exchanges, DEXs. Participants known as liquidity providers contribute equal value amounts of the two different tokens in the pool. In return, they receive a liquidity token representing their stake, which can earn them transactions on their fees rewards. This setup eliminates the need for a centralized market maker, allowing for more democratic and efficient market process. For example, in platforms like Uniswap, a liquidity pool might contain a pair such as ETH and USDC, enabling users to swap between Ethereum and USD coin seamlessly. Prices within these pools are automatically determined with an algorithm based on the ratio of tokens in the pool, following the principles of automated market making, AMM. This mechanism not only ensures constant liquidity, but also empowers the users by decentralizing trading functionalities. So some of the safety risks and challenges that we have to be aware of. So while liquidity pools offer significant advantages, including democratization and reduced trading friction, they do introduce unique risks. So understanding this risk is paramount for protecting investments and ensuring a sustainable engagement, especially with the DeFi platform. Okay, so number one, impermanent loss. One of the primary risks associated with liquidity pools is impermanent loss, which occurs when the value of the deposit assets changes relative to the initial value at the time of the deposit. This can lead to a situation where, despite earning fees, a liquidity provider might have been better off simply holding the assets instead of pairing them with another coin. This risk is inherent to markets within significant volatility, and while it is termed impermanent, if not managed, it can lead to actual financial loss. Number two, smart contract vulnerabilities. Liquidity pools offer unsmart contracts, making them susceptible to bugs and exploits. A flawed contract or one with hidden vulnerabilities can be exploited by malicious actors, leading to significant losses. So audits and comprehensive testing are critical to ensure the integrity and security of these contracts. Yet, even audited contracts have been compromised in the past. Number three, market risk and volatility. The crypto market's notorious volatility can impact the safety and profitability of liquidity pools. Significant price swings can not only contribute to impermanent loss, but also affect the overall liquidity, influencing the returns for those providing it, mitigating risk and enhancing safety. So to mitigate potential risk, it's essential for investors to adopt a strategic approach to DeFi participation, prioritizing safety and due diligence. Number one, diversification and asset selection. So diversification, or diversifying your investments across multiple pools and choosing less volatile asset pairs can reduce exposure to impermanent loss. Selecting pairs with stable coins like USDC and DAI alongside assets with robust liquidity can offer more predictable outcomes. Number two, smart contract audits. Investing only in liquidity pools of platforms that have undergone rigorous third-party audits can help safeguard your funds. These audits assess the vulnerability of smart contracts, providing insights into potential risk and offering peace of mind for the investors. Number three, continuous monitoring and rebalancing. Active monitoring of the market and regular rebalancing of positions in response to market conditions can help. It will help mitigate associated price fluctuations, and it will also be a proactive approach, enabling investors to adjust their strategies, their dynamic strategies, optimizing for the yield when managing their risk. Number four, insurance protocols. Utilizing decentralized insurance options such as Nexus Mutual or Clever Protocol provides additional safety nets, allowing investors to protect against smart contract failures and specific DeFi exploits. These protocols offer policies that can reimburse losses, creating a layer of security. Liquidity Pool stands as a testament to the innovative spirit driving decentralized finance, offering remarkable opportunities for earning and trading within the crypto ecosystem. However, the associated risks necessitate a thoughtful approach to investments, underpinned by an understanding of the mechanics and potential vulnerabilities of the liquidity pools. By employing prudent risk management strategies and prioritizing security measures, so investors can leverage the full potential of the liquidity pools, navigating the DeFi space safely and profitably. I encourage you to do so. Understanding and adapting to the unique world of liquidity pools empowers investors to confidently engage with crypto markets, fostering a new era of decentralized financial participation that emphasizes both opportunities and security. So some of the educational perspectives that I want to highlight: understanding cryptocurrencies is essential for modern real estate investors seeking to diversify portfolios or optimize investments strategies across international boundaries. So cryptocurrencies evolve, okay? So you have to stay ahead of these developments and technologies accompanying regulatory changes and adapt in this space to thrive. So you have to do that. In conclusion, Embracing financial innovations as the adoption of cryptocurrencies accelerates, investors stand on the precipice of a financial revolution in real estate. The integration of these digital currencies can lead to innovative investment strategies, fostering opportunities and growth beyond conventional paradigms. So, I encourage you to connect with us further for further insight. We have a community access subscription to our community group so that you can stay updated on the latest trends, innovations, and best practices in cryptocurrency. Financing your real estate through crypto. Number 2, we have a course. You can gain access to a wealth of resources, including step-by-step instructions, case studies, and guides designed to enhance your comprehension of this dynamic field. Number 3, we have Liquidity Funding Pools Coaching. Our knowledgeable team is eager to provide insights tailored to your needs, whether you're a seasoned professional or just starting out in the crypto real estate world. And number 4, patient. So you can join our syndicate, our group of investors who collectively to purchase commercial property. So join our syndicate group and you gain access to our CLD coin. So we have webinars and also industry leaders that bring us in this space. You can learn more about this and all of these opportunities at concretebuild.org. Thank you for your time.